Hi there, and welcome to Jill's Quest for Riches. In today's episode, we are going to talk about the DCA or dollar cost averaging. On the agenda, we have first a definition. What is it? Why is it used? An example that I prepared for you guys, some pros and cons, and we wrap up with some extra stuff you need to know about DCA. If you're ready, I'm ready. Let's go. So first up, what is dollar cost averaging? Well, it's actually quite simple. Whenever you decide to invest in a company or an ETF or a tracker, you decide, okay, how much money do I want to put in? Let's say I want to invest €1,000 in Intel stocks. Well, traditionally what I would do is I would just buy Intel stocks for €1,000 today and that's it. Now with dollar cost averaging, what you would do is spread it over a period of time into multiple smaller transactions of the same amount. That's very important. So instead of buying for €1,000 Intel shares, I would be maybe spreading it over 10 months and every month putting in €100 Intel shares. Key here is that you invest over a period of time, so every single point that you buy, you actually pay probably a different price than the point in time before, and you always invest the same amount. So the only thing that really switches or changes between the times you invest is the amount of shares you get in return for that same amount. Dollar cost averaging is also sometimes called the constant dollar plan, and just to be clear, it's called dollar cost averaging, but you can apply the same technique with euros or pounds or any other currency. Okay, but why would you want to do dollar cost averaging? Well, it's very simple and it's all about what we call timing risk. Timing risk has to do with the fact that the prices of equities or assets change over time. And you don't want to be the person that goes all in, my €1,000 for Intel stocks, just at the point before the stock drops drastically and stays low for an extended period of time. That's what we call timing risk. With dollar cost averaging, you're spreading your risk. You will be buying at multiple time points at different price points. So you won't be just before the big valley of death, let's say. And an extra advantage is, since you're investing the same amount every single time, you will be buying relatively more stocks at moments where the price is low, because you will be buying more shares for the same total investment. So to sum it up, dollar cost averaging helps reducing bad timing risk, which is the risk of buying everything all in when the price is actually a bit too high. But at the same time, it also reduces your chance of outsized returns, because you won't be buying all in at the most favorable point either, at the lowest point. No, you will be spreading over time and averaging that purchase price. It's actually in many ways comparable to diversification, with the main difference that here you're not spreading over different asset classes, but you're spreading your investment over time. I usually find it easier to learn things by using a practical example, so I suggest we do just that. Now, in the table that I prepared here for you, we actually see the price evolution for a specific ETF from HSBC on the S&P 500, so a relatively standard ETF. In the first column, you see the dates at which I checked the price. We're going from March this year all the way back to March last year. Then the second column, we have the price at those dates, the moments when we would buy if we do a monthly investment. The third column is the investment. As I said, for dollar cost averaging, you always invest the same amount. So here we're actually going to invest 11 times €300 instead of, at the bottom of the column, an initial investment of 3,900 all at one go. And in the last column, the most interesting one, is the amount of shares we bought at that date, at that price, with that investment, with those 300. And you see, I put some bar charts there as well to visually show you that there's points where we buy more and there's points where we buy less. Very clearly there, exactly 1 month ago, we had the big dip in the markets due to COVID crisis. And there you see in April 2020 that we would have bought 11.26 shares, whilst the month before and the month after we would only be somewhere in the 9.5, 9.7 shares. And then if we go further down, we see another spike around November 2020. There again, the price had dropped a bit, so there we were able to buy a little bit more. Now, the main takeaway here in this example all happens at the bottom of this table. If we look at the average price, so overall, if you would have taken the average of these 11 months, we would have had an average price of 33.80 euros, whilst by doing dollar cost averaging, if we give the different prices the weight of how many shares we bought at that price, we actually have a slightly favorable price of 33.50 euros on average. So that's a small gain, nothing drastic, even though there were actually some drastic movements in the market in March last year. But since there was a very fast recovery, the difference on the long run was not that big. Mind though, 33.8 or 33.5, the average prices are both higher than if we would have just paid everything up front at the price the 1st of March 2020, which was 31.72 euros. So if we would have invested everything from the very first date, no dollar cost averaging at all, our return would have been higher. So it's still important to note in this example, and in many examples this will be the case as well. The big advantage you would have here is actually that on the 1st of April you would have not been like completely shocked and traumatized by your investment that all of a sudden lost a lot of its value. No, you would actually be quite confident and okay, because that means that this month you can buy more shares for the same amount, and probably the month after as well. And that last remark brings us to the pros and cons. So one big advantage of dollar cost averaging is of course reducing the risk of bad timing, which is very nice. But a second relatively big advantage is actually that it makes your investment more mechanical, more methodical, and that reduces the risk for emotional decisions. Like if you invest everything just before a crisis, then everything drops. Maybe you want to sell everything to not get even more losses. So just the fact that you spread it over time means that, okay, you lost some money on the investments you made before that crash, but you also have a positive outlook, namely from now on I can buy more of the same shares of companies or ETFs that I still believe in, of course, for less money. So that stabilizes everything a bit. Then the disadvantages, well, reducing the bad timing risk also reduces the chance of having good timing, of course. So there's way less chance that you buy everything all at the low point. Well, there's just no chance because you spread it over multiple points. Depending on the platform you use and the size of your transactions, your transaction costs could drastically increase as well, at least from a relative point of view, because you do more transactions instead of just one big transaction. And then the last disadvantage that I want to discuss with you, actually something that I already brought up in the example, is mainly that markets usually go up over time. So maybe in an individual stock you're not that certain, but definitely when you invest in a tracker or in a bigger market, then you can be quite confident that on the long run they will go up. So it's more interesting to invest everything as soon as possible, as early on as possible, to maximize your potential gains. But then of course you're not doing dollar cost averaging and you're foregoing the advantages of dollar cost averaging. So let's wrap up with a few last things that I want you to know. First of all, dollar cost averaging is not a return maximization technique, it's more a risk mitigation technique. Secondly, it only works if the price of your equity is drastically lower than the periodic amount that you're investing. So if we go back to the example, we're investing 300 euros every month. Well, if it's to buy an ETF at around 30 euros, that's fine. The price rises a bit, then I'll buy only 9 ETFs. If the price lowers a bit, then I'll buy 11 ETFs, perfectly fine. But if my monthly amount is 300 and the asset that I want to buy is 280, then the month in which I will be buying nominally more assets, so 2 instead of 1 share or ETF, will have way more to do with how many months have passed and I've been able to put aside that residual amount, the difference between the 300 euro and the price of the asset. That will have way more impact. It's been 10 months, so I now have enough money to buy an extra share instead of the actual price of that share. One big exception, of course, is if you can do fractional investing. So if you can buy part of a share, then you're perfectly fine. That actually is very, very suitable to do dollar cost averaging. Furthermore, dollar cost averaging is very often used when buying indexes, so funds covering a whole market or a whole industry. And it's a very important technique when you want to do passive investing. So that's it for today. I hope you learned something. If you liked this video, be sure to like, and if you want to see more videos like this, don't forget to subscribe. Have a great one. Bye.